There is a point in every cycle where retail fear meets institutional strategy. That point is right in front of us right now. Most investors are selling their shares because they are afraid, but the biggest players are quietly putting more money into the game. Many times in the past, when regular people sell at the bottom, big buyers buy with both hands. It's not until much later that regular people start to buy back in. Today, this same pattern is playing out in stocks, Bitcoin, and even XRP. This is not advice about money. Pay attention to what's going on. Regular people just sold almost $1 billion worth of stocks in crypto in back-to-back weekly sales. That's after buying every month for almost 9 months. Which brings us to the same week. The institutions bought $1.1 billion worth. This was their longest streak of buying in a row since the bear market in 2022. Take a look at that. Normal investors are pulling their money out of the market after a small gain, but smart money is quietly getting ready for the next big thing. A flood of new money. The place where most people miss it is because they don't look at M2 money quantity. They're not looking at the cycles of cash. There is no focus on the Fed's plan. Instead, they're acting on their feelings and selling way too soon, which is something we've seen many times before. There is more money now than there was 18 months ago, though. Rates are going to go down, and money will be coming in soon. Those in power know it too. They're getting ahead of things, leaving stores behind. Let me say this quickly before we go any further. To place yourself like institutions do, you need to have the right tools and know-how. Because every time the Federal Reserve has changed its mind in the past and cut rates or eased monetary policy, the economy has gone through a huge boom. Just think back to November, when the Fed first did something. The markets went up sharply and reached new highs by January. It wasn't a mistake. That was the money moving around. It's going to happen again. So ask yourself, do you want to be on the side of small traders who are acting out of fear? Or would you rather be on the side of firms worth billions of dollars that buy a lot while prices are still low? Because what you decide now could affect how much money you make in the years to come. Cathie Wood has been one of the most vocal people calling attention to this exact setup. Bitcoin is what she calls a once-in-a-generation scarcity asset. There is a hedge, a new technology, and a brand new type of object that has never been seen before. She doesn't mean that Bitcoin will go back to $30,000 or $40,000. She thinks she will make $1.5 million in 5 years. She also lists 3 cars. Using it instead of gold, getting institutions to accept it, and the demand from people in emerging countries who need protection against losing their wealth and inflation very badly. She's not the only one. Pay attention to how big funds, pensions, and asset managers act. They didn't pay attention to Bitcoin for decades, thinking it was a crazy idea, but now it's too late to ignore. ETFs are now available. Custody options are getting better. The compliance rails are being put up. The machinery that made gold popular is now being used for Bitcoin and other cryptocurrencies. The supply and demand situation will get crazy once institutions really open the doors. Because unlike paper currencies, there are strict limits on how many can be made. Let's look at Bitcoin's supply. 21 million pieces at most. We've already mined almost 20 million. In a time when everything else is becoming less valuable, the fact that something is scarce draws capital to it. On top of that, AI and automation are making other parts of the business less scarce, like labor. It's easy to see why markets will chase the few assets that still have it. Bitcoin is at the very top of that list. But most people don't fully understand this part. Bitcoin isn't just real money. This thing is both a risk-off and a risk-on asset. Like gold, it moves when people are scared. It also works well with tech because it's part of a new money system. It has a completely different edge over everything else on the market right now because it is dual. During the Greek crisis in 2015, when many people were afraid that Greece would leave the EU, Bitcoin prices went up every time the news got bad. Now let's move on to the US regional banking problem. It did the same thing again. It kept people safe when they lost faith in traditional institutions. It works like a tech play at the same time, taking advantage of growth cycles, new ideas, and money coming into digital assets. That's why Wood says it's a big idea. That's why organizations are coming around. That's why the current fear selling in stores is giving them exactly what they want, a cheap supply. Don't forget about what's going on in other parts of the market, though. As oil prices have dropped so sharply, it's been like a tax cut for customers that we haven't seen in years. Lower energy costs have an effect on the whole economy. They lower price pressures and make the environment much better for risk assets. A very small number of people are paying attention to it, but it's very important. The US dollar is also important to this. It has been weaker in recent weeks, but if you look further back, it's still been strong in the past. If reform, tax cuts, and lower tariffs happen, the US has a much higher return on capital than the rest of the world, and that's a dollar gain. Do not forget the Reagan years. all over the world had to work together to bring down the value of the dollar, which got so high at that time. That wasn't being weak. That was being in charge. It's possible that we're getting ready for another run like that. The best part is now here. The Fed is stuck. They have already cut the amount of money in circulation more quickly than we've ever seen. At the same time, though, as growth slows, political tensions rise, and pressure builds, rate cuts are bound to happen. That means that money will be pumped into the system soon. Cash flow is fuel, and that has been the main reason for every big rise in markets over the last 100 years. After a small bounce, retail investors sell their shares, and institutions buy it all up. This is how the game is played right in front of you. A lot of people have played this game before. Which side are you going to be on? That's the only question. That brings us back to the point. Bitcoin, XRP, gold, and even stocks are on the verge of a liquidity rise. The lights are going off and on. A lot of organizations are moving. Also, stores are once again on the wrong side of history. Taking out the noise, what we're seeing now is a perfect storm of events that could change the course of not only Bitcoin, but also the whole crypto and stock complex, because there is no doubt that these markets are linked more than ever. The same amount of money that drives the S&P 500 up is also driving Bitcoin's next leg up. The same institutional capital that used to stay out of digital assets is now starting to pour into them on a large scale. Now, the difference is in the way things are built. In the past, Bitcoin's price mostly changed because of speculation. Small retail traders, pockets of wealthy people, and a few risk-taking funds were the ones who caused volatility. However, today, there are publicly traded businesses that have Bitcoin on their books. ETFs are now legal and can be bought and sold on big exchanges. There are national wealth funds that are looking at allocations. That's not just a guess. That is structural integration at work. This is what makes big buying so strong right now. They aren't gambling with Bitcoin, that's why. They see it as a necessary hedge, a way to diversify their portfolios, and sometimes even as a core holding. That way of thinking is very different from the beginning. Institutions don't play small when they make a promise. It doesn't cost them a few $100s all at once. They are moving with $1 billion. Now think about this. The amount of Bitcoin that is issued is decreasing on a mathematically set plan. Every 4 years, the flow is cut in half, which means less new supply at a time when usage is growing. It won't be years before the next half. It's almost there. A trend has been seen in every cycle before this one. When supply tightens and demand rises, prices change by a huge amount. And because institutions are involved in a way we have never seen before, this repricing could be much bigger than any other wave. But let's look at something other than Bitcoin for a moment, because what's going on with Ethereum, XRP, and other top assets is just as important. Because it can be used to make payments across borders, XRP is in a totally different group than Bitcoin. XRP is infrastructure, a tool made for speed, liquidity, and payment. Bitcoin is global digital gold. If more banks, payment providers, and banking institutions use XRP, its price changes won't just be guesses. Valuation will be based on real-world flows that are driven by usage. On the other hand, Ethereum has become the most important part of decentralized banking. Protocols have lots of money locked up in them, apps are getting bigger, and Layer 2 solutions are lowering costs while capacity increases. The environment seems to be getting better in every way. Once more, but this time, organizations are paying close attention. For them, Ethereum is more than just a currency. It's a digital market and a network that makes money, fees, and value. That's why asset managers are putting out ETH products and why so many developers are jumping into the ecosystem. Even though Ethereum is volatile, the main use case for it is still very solid. What's the link between these things? Being scarce and adopting. Bitcoin is hardwired to be scarce. Ethereum is useful, and it has network impacts. XRP is aligned with institutions. Together, they show a new type of assets that don't depend on regular profits or rewards, but on technology, usage, and demand around the world. In this case, rate cuts, liquidity, and monetary policy are very important because of this. Because risky investments do well when the cost of capital goes down. Stocks go up. Cryptocurrencies go through the roof. A bit is made on gold. It all comes down to the fact that money has to go somewhere. Institutions that have trillions of dollars don't want to just leave them in cash and do nothing with them. For their own good, they have to look for results. And in a world where debt is growing, growth is stopping, and feared currencies are losing value, assets that are hard to get and widely used shine the brightest. Now let's look at the psychology of retail flows versus institutional flows, as this explains a lot of the present difference. Retail is based on feelings. Their friends talk about gains, charts look good, and they buy when those things happen. When markets pull back, fear takes over, or confusion starts to creep in, they sell. This is reacting. It's only temporary. It's based on life. On the other hand, institutions work based on placement. They buy things when people are afraid, sell things when people need cash, and spread their money around among different assets that give them different kinds of upside. They think about the future in terms of years, not weeks. They're more interested in catching the big move than in the day-to-day changes. That's exactly what we see now. Stores selling out of fear after a small recovery. Institutions buying over and over, 6th week in a row. Since the last bear market, this is the longest run. Why do retail stores sell? The real question is why they always sell at the wrong time. And the answer is that they don't understand cycles. Every time the money supply grows, the market goes up. The lag can be seen coming. There is no denying the flow. Still, stores miss it over and over again. What will happen next? Rate cuts bring in more cash, markets start to price in the turn, and the prices of assets go up. As the rise speeds up, small buyers who sold early have to buy back in at higher prices. That buying makes the price go up even more, and institutions that got in early can ride the wave with little trouble. It's been the same story for decades in all kinds of assets, at all times, and in all kinds of places. Let's connect this to bigger picture changes, because changes in geopolitics are making crypto even more important than changes in monetary policy. People and companies look for other options when capital controls get stricter, when inflation lowers purchasing power, and when governments abuse their control over money. Bitcoin is that other choice. XRP could be that different way to pay. In terms of digital infrastructure, Ethereum could be that other option. This is not a story from our area. Worldwide, take a look at new areas. Bitcoin is not a risky investment in places where prices are constantly going up. Countries can disappear overnight, and wealth can be taken away with the stroke of a pen. To stay alive, it's like a safety plan. And that insurance policy is getting bigger because of one easy thing: getting online. Anyone with a phone can take part. That being general changes everything. There are holes in the system even in countries that are doing well. The amount of debt can't be maintained. Budgets are getting tight. There are limits on what central banks can do. And every time they try to make things tighter, they might break something. It happened with community banks. And we saw it happen with the UK pension problem. It will happen again. It's not getting weaker, but stronger with each break. Let's go back to metals for a moment, because gold and oil also tell us something. The drop in oil prices is like a secret stimulus that lowers pressures everywhere. We think that will lead to growth and more spending. Gold is still seen as a safe haven, but Bitcoin's mathematically set supply is much more limited than even gold's limited supply. You can still get gold from the ground. No, Bitcoin can't. That difference is important, especially for organizations that base their values on the idea of scarcity. In spite of its short-term drop, the US dollar still holds the most value. But history shows that being strong can bring its own problems. Pressure to export. Global cash is tight. Interventions that are coordinated. A rise in capital gains in the U.S. due to deregulation and tax cuts will lead to a rise in demand for U.S. assets and the dollar. This event makes the outlook for risk assets priced in dollars even better. It goes around and around. It's pointing in one way right now. Better. So we have the right set of institutions building up at a large scale. Fear-based retail sales. More money from the Federal Reserve is on the way. Assets driven by scarcity that are ready to blow up. Unstable geopolitics are driving demand for crypto around the world. Trends in commodities are helping growth without being seen. That's not a lie. That's how it works. A setup that looks exactly like the moments before big breakouts in the past. You'll understand why this arrangement is so uncommon if you give it some thought. All of these things don't usually happen at the same time. Usually you get signs that are broken up. Some are positive, some are pessimistic. But everything is coming together right now. Those in power know it too. That's why they don't hesitate. That's why they haven't stopped buying. That's why retail runs the risk of falling behind again. To understand what's going on now, you need to know how strong cash cycles really are. There's no chance in them. They're not just ideas. They keep the global markets going. Risk assets go up when cash goes up. When there is less liquidity, markets fall apart. And now, right after the strongest decline in decades, we are going straight into a new phase of growth. This is not a guess. It's math. A decrease in interest rates, an increase in cash flow, or a change in the tax system meant to boost growth all bring new money into the system. That money isn't just lying around. It wants money back. The investments that make it easiest to get asymmetric returns, crypto, scarce commodities, and high-growth stocks, get the most help. Retailers continue to make this mistake, which is a shame. They read that inflation is going down. There's a chart that's moving around a few percentage points. They are in a hurry to sell because they think the move is over. But organizations see the effects that come later. They know it takes months for money to fully move into markets. They know that the best times to make money are usually after stores have given up. So they're buying now when fear is high, when there is a lot of confusion, and when stores are selling their goods quickly. Remember the last time around? Late in 2018, markets fell like a rock. Small buyers ran away, institutions took a quiet stand. As the Fed changed its mind in 2019, risky assets went up. People who sold too soon missed the rise. The same thing took place in 2020. Pandemic panic selling, buying by institutions, trillions of dollars worth of new money coming in, and one of the fastest rises ever. The plan stays the same. People who play do it. The players are bigger, better coordinated, and more driven than ever before in this set. These are global asset managers who are in charge of trillions of dollars worth of assets. Long-term hedges are sought after by pension funds. Stakeholder wealth funds are moving away from paper currencies. There are a lot of them. With just one allocation move, these whales can turn the whole market on its head. Let's talk more about the internal battles that happen at these times. Institutions love when things are unstable. They get pleasure from making people scared. They need stores that sell to buy things. So they can build positions without driving prices too high. They need weak hands to shake out. Every scary story, every drop in the chart, and every panic-driven sell-off are all part of the transfer of wealth from people who can't wait to people who can. Right now, that move is taking place right now. Billion-dollar retail sales. Institutions are spending billions. The cycle keeps going. This time, though, it's not just stocks. It's not just bonds. Yes, it's crypto too. That's the main difference. Crypto is built to be extremely scarce, while regular assets are not. The 21 million cap on Bitcoin means that big companies can't just flood in whenever they want and expect there to be an endless supply. They have to compete if they want to get seen. They have to get what's out there. And when demand goes up a lot and supply stays the same, the upside goes through the roof. The network effects of Ethereum make this even worse. Everything that is made for Ethereum, every layer to scaling solution that is released, and every new wave of adoption makes the ecosystem stronger. The government doesn't just see ETH as a coin. They think of it as investing in a global decentralized market like stocks. From that point of view, money comes in a different way. Then there is XRP, which is in its own lane. Settlement across borders, speed, and providing cash are all directly linked to financial infrastructure. If people keep using XRP, it won't just be a speculation. It's an important part of the world's banking system. They know that kind of placement is rare because they see it all the time. Now add the world's background. Even though inflation is going down in the US, there is a lot of uncertainty around the world. Devaluations of currencies, debt problems, and political shocks all make people want scarce neutral assets. Bitcoin is not biased. Ethereum is not biased. XRP could also play that part, but only if it is widely used. This isn't a theory in emerging economies, it's the truth. Today, people use Bitcoin to keep their money safe from inflation, capital controls, and the government getting too involved in their lives. That trend will only get stronger. The similarities to the use of gold are obvious. Gold was thought of as an old thing for hundreds of years until money systems started to fail. After a while, it became necessary. Bitcoin is moving faster because of digital rails and the ability to link to the internet around the world. Also, don't forget about how technology itself affects things. AI, automation, and robots are making it easier to find workers and make things. As some parts of the world become more plentiful, buyers will pay more for the few things that are still hard to get. Bitcoin's lack of supply, Ethereum's network, and XRP's usefulness. These are assets that are set up to take that price. At the same time, commodities like oil are slowly changing the big picture. Since the price of oil has dropped sharply, people and businesses are getting what is essentially a huge tax cut. Less expensive energy affects everything, from transportation to industry. This frees up capital and makes inflation less of a problem. That's fuel for growth, fuel for risky assets, and fuel for the exact kind of rally that banks are getting ready for. The dollar is another one. Long-term trade weighted, it's still very strong, even though it's been weak in the short term. Demand for dollars goes up even more if freedom and tax cuts boost U.S. returns. Strong dollars bring money from around the world. The money has to go somewhere. Also, U.S. stocks are close to all-time highs and bonds aren't as appealing, so valuable assets like Bitcoin, Ethereum, and XRP become top choices. This combination of alignment, liquidity injections, institutional acceptance, scarcity dynamics, global instability, and relief for commodities is not only rare, it's also unprecedented. The organizations are aware that this type of situation only happens once every generation. That's why they don't hesitate. That's why they buy when stores are selling. They're getting ready for a future that most regular buyers can't even see yet. In the end, it's easy. Cycles keep going. Markets are driven by liquidity. Scarcity is key. And organizations take a stand early. The signs are flashing bright green right now if you pay close attention.